Or do you think you put more money for it?
How risky the client is?
Yeah, you look at all your loans and see how risky it is, and you put some money in for that. So you might think that people have more up for loan loss reserves or have more risky loans. But it could be that the bank is also, wanting to safe harbor. They want to stay safe. Maybe they're expecting some bad times to come. So there's some pluses and minuses of putting more money up, and there's also pluses and minuses of putting less money up. But we're always going to put around that 1% on there. Securities, we'll talk again, of course, about securities, but usually they're categorized into short-term and long-term securities. Short-term is 1 year or less in maturity length, and long-term is greater than a year. We'll get into what we can invest in, but usually short-terms are T-bills, municipal securities. Municipal meaning that they're issued by cities and states and maybe school districts, maybe counties, maybe universities. We're building a new cafeteria on campus. We had issued bonds for that, and those are municipal bonds. So you can actually buy SFA bonds. They're out there right now. And long-term securities, there's U.S. Treasury and then agency securities. So agencies are the Federal Home Loan Bank. They have securities, FHA, so all these different federal agencies also issue securities like the U.S. Treasury does. And the mortgage-backed securities, those are mortgages, more or less, that are pooled together. And then most banks don't get in that form, corporate bond stuff. All right, with the bonds, all bonds have to be categorized into one of these three categories. Held to maturity, trading account, or available for sale. And this was at FASB 115 that we talked about last time. That all securities have to be categorized in one of these three. This trading account is not really used by smaller banks. It's usually they're not actively trading their bonds back and forth, so we don't talk about this one very much. You get held to maturity and available for sale, and you'll see that when you go through that most bonds are categorized as available for sale. Even though the bank may not be looking to sell them, they're still you still can sell them, and so categorizing available for sale does have a consequence in that they have to be categorized as market value on the balance sheet. Well, what happens when, like in the last year, interest rates have gone up a lot? They went from 0% up to 5%, short-term rates did. And most of the rates also went along with it, kind of increased in value. So what happens when interest rates go up? We had to mark these to market value. What did we have to market? We had to mark these up or down. Interest rates went up. We had to mark them down. So that's not a big deal. We can mark them down. But if you have assets, we have some loans and securities. And we have So if you mark securities down, you have less securities on your books, that means you got less assets. Well, you have to mark something down on the right side. What are you gonna mark down? You gonna mark down your deposits? I hope not. I don't think anybody would want you to mark down your deposits. So what's the only thing you can mark down? You have to mark down equity. And who doesn't like that? I assume the bank doesn't like that. The people that own the bank, because they got less money. So they don't like it when we have to do this. However, if they understand that this markdown is temporary, in case we will hold the maturities all the way till they mature, the securities all the way till they mature, and so we won't take that loss. And so you have to keep reminding your shareholders that this is a temporary thing. This is something that will go away. So actually, with regulators, when they come in and look at your bank, they don't really look at that, what we call bank balance sheet equity. They look at your regulatory capital, and your regulatory capital takes that out of it. That's you'll be able to see a lot more of that when we look at our bank analysis project. You'll see that usually these banks have a lot of available for sale securities, and that tends to cause a little bit of problem, but hopefully not much. Now, where it will come in to play is if we come into some type of crisis, and maybe banks are in trouble, and if you get in trouble, now you might have to sell some of your securities. If you have to sell these securities, you have to sell them at a loss. And that's where it could come in trouble. So if you need some liquidity or something like that, all of a sudden this becomes a problem. It becomes an issue. But of course, if you're a big bank, you're too big to fail, and you don't have to worry about it. All right, the non-interest cash and due from banks. Of course, we have cash that we hold in vaults. Usually we don't hold, banks don't have too much cash in their vaults, maybe 1%. Money we hold at the Federal Reserve and other institutions. So these are what would be Fed funds sold on your balance sheet there. Whereas have at the top Fed funds sold. So those are usually deposits held at other financial institutions. So if we had too much money sitting around and we don't want to sit around on too much cash, so we go and lend it to other banks or lend it to the Federal Reserve. And that's usually overnight lending. Usually those are one-day lending. And that's what we do with that. And then there's cash items, process of collection. So like checks have a little float on them 1 or 2 days. So that's what that is. But generally, we have cash at the very top. That's the vault cash, and then Fed funds sold is other banks. And then finally, other assets. We have on here. We have premises. That's on this balance sheet as well. And then other real estate owned REO. Like I said before, if you have loans that have defaulted and you've had to collect what they put up for collateral on the loans, so if they put up some land up for loans, now you own land. And banks aren't in the land owning business, they have to sell that land, but while they own it, they put it as OREO. So and it's always something to watch. If their OREO gets too big, that means they're defaulting on too many of their loans and they got some problems. They got a loan officer or two that is making some bad loans, and we got other things to worry about. So banks generally don't want too much OREO, that's about it. So that's the bank assets. There's another example of assets on balance sheet. similar to this one right here. All right, now your deposits. First is we have your transaction accounts. So these are your checking accounts. You have, of course, your demand deposits, now accounts, ATS, and money markets. So these are all transaction accounts. So accounts that you can do transactions on almost on a daily basis. Some of them, you know, put limits on it, so we can only write 6 checks a month on this. Some other banks have different rules and regulations how much you can access these. But these are usually accounts that you have for all your transactions that you do on a monthly basis. And these are pretty substantial with your bank. With this bank, you can see that we have 158 million of checking accounts. And usually those are good to have checking accounts because you don't pay much interest on these things. So these are good. In fact, yeah, we pay 100,000 interest on 158 million. So savings and time deposits. These are your savings accounts and your CDs, more or less. So if CDs are below the $250,000 amount, they're regular CDs. If they're above that, we call them jumbo CDs. That's if you've heard that term, jumbo CD, that's just what it means. It's above the 250,000, and usually $1 million is typical. So on here, the savings accounts and retail time deposits. So retail time deposits are what we're looking for. Are for these right here. That's a bulk of your deposits. In this case, that's 241 million and 233 million. So that makes up a big chunk of what you got. You'll notice that right below it says corporate CDs. And those are broker deposits. So if difference between corporate CDs and retail time deposits is retail time deposits you're getting from your own customers. You're going out there to your own customers and offering these CDs, and they're taking them, they're buying them, doing anyone. And most of these are considered really good. But corporate CDs or borrowed funds, broker deposits, they're out on the open market. So we go on the open market and we say we got $1 million CD, 4% interest. He puts it on the open market. And the reason we differentiate between those two is because if interest rates change, let's say 4.5%, 5%, which one are more likely going to leave you if that happens? The ones on the open market, because they're just shopping around. They don't care who they are. They just want the best rates. And the retail time deposits, your own customers, they're more likely to stick with you if interest rates change a little bit here or there. So, in fact, we call these borrowings, all these things, because we have to go and these aren't our own customers. What we got with our own customers were the retail time accounts and savings accounts, transaction accounts. Those are our own customers. Other borrowings is, we don't have too many foreign offices, but Federal Home Loan Bank borrowings. If we have a certain amount of assets, we can borrow Federal Home Loan Bank. And then Fed funds purchased or securities sold. So that is the repurchase agreements, is a securities sold agreement to repurchase, and then the Fed funds purchased is in the, on the liability side as well, under deposits. So all of these things are what we call borrowed funds. This is if we issue too many loans or have too many securities for how many deposits we have, we gotta do something to get some more money. And then, so we can always get more money by doing this stuff. We can go borrow from the Fed, we can borrow from other banks, we can go get some corporate CDs. We can always go out and get more money, but these are gonna be more expensive than our transaction accounts, or our savings accounts, or our retail fund accounts. So these are more expensive, but we can always go, we can just go purchase these. So we can just go to our computer and type something in, and we got some deposits. It's going to be expensive. You're going to pay probably as much as you're going to get for loans or your securities, maybe even more than securities are. So you don't want too many of these. They're okay for a little while. They're okay for some of these things. The repos aren't bad. Fed funds can be okay. Federal Home Loan Bank, they start getting a little expensive. And you don't want to put Federal Home Loan Bank, you don't want to borrow from them and put it in securities. It's okay maybe to put it in loans, but your margin's not going to be too much different. You're going to be a lot better off if you just get standard deposits than you get these other borrowings. In fact, these are called two different things. So all those standard, your deposits, your transaction accounts, and are what we call our core assets, our core liabilities, core deposits. What we mean by core is that they're stable. Usually they're not withdrawn. They usually don't go other places if interest rates change. So that's what we're talking about with core. And that's what we want more of, because that means that they're going to stick around. These borrowings are lumped into what we call volatile liabilities. And that's what you don't want, because if you all of a sudden have a bunch of these and interest rates change, these volatile could all leave you. And now you're stuck. Now you're left with, you have all these securities and all these loans, and you got nothing to fund them with. So now you're going to be in trouble, and they might come and shut you down, shut down the bank, if that's the case. So we like these core deposits. Usually they're cheaper than these volatile. So usually the core is safer, cheaper than volatile deposits. All right. And then lastly, we got equity. You can see on here it just says equity. Really, I think just have common stock and retained earnings. You can see the rest of this. Capital reserves, but really your equity is what you have in equity and in retained earnings. And of course your reserves, I guess are in there. But we just lump them all into owner's equity on this sheet. So that is the extent of the balance sheet. You can see on liabilities, we tend to lump them into core deposits and our volatile deposits. And we got equity on them. And we'll get into what these ratios mean next time. All right, now we flip the page. And on income statement, it looks a little different. In that you have interest income, interest expense. Most income statements, you have revenues and expenses. That makes sense. But these aren't all the revenues that we have for the company. There's interest expense. We also have non-interest revenues and non-interest expenses. So, we always start off with interest income. So everything that earns interest, so those are all our loans and all our securities on our balance sheet. We look at all those and we calculate whatever they earn interest and how much they earn interest for the month. And that goes on our interest expense, interest income. So you can see that we have loans and then securities, tax income, tax exempt, are all on interest income. So that's what goes on your income statement. And interest expense are all those deposit accounts that we talked about. So we got checking account, savings account, retail time accounts, corporate CDs, borrow funds, FHLB borrowing. And then, so we have all of those. We just add up what the interest income, interest expense is. And so we calculate that, however that, what that is each month. You can see that looking at over the year, we made a lot more in interest income. We started the year off making 9.8 in interest income, and we ended the year making 11 million in interest income. So we went up 1.2 million. So that was good. So the bank's it was growing. I think the bank grew from 651 million to 777 million. So the bank grew, and we grew interest income. I mean, if the bank grows, we should make more money because we're more things we invest in. But if we look at the interest expense was about 4.4 million, and went up to 5.6 million. So that's also 1.2. So if the interest income grew 1.2%, and the interest expense also grew 1.2%, that's not good. If we would assume that the interest income is almost twice as big, so that's twice as much, that interest income should grow more than interest expense. So I assume this is also a reason why the bank fired their folks and decided to hire y'all. That they're not managing their interest income, interest expense very well. They should make more money on interest income than they spend on interest expense. Anybody can make the same amount or even more on interest expense. We just go borrow a bunch of money and we throw it in securities. I mean, and then you go home the rest of the month. And that's easy to do. Usually those borrowings cost more than what your securities are going to cost you, and you're going to go down even more. So in order to be a good bank, you're going to have to get deposits and issue loans. And that's going to take some time. You have to go out and chase deposits. You can go out and talk to people and get loans. You have to go out and talk to people and do that, and you'll get your loans. But net interest income, you'll see that beginning of the year was 5.4 million, and sure enough, now it's 5.4 million as well. So again, the interest income is the difference between interest income and interest expense. It didn't increase, it didn't change for this particular bank. And that's one of the main drivers of what banks are looking at, is that net interest income. All right. The other thing on income statement is the non-interest income. because they make money from other things besides interest. So we got interest income, interest expense, net interest income. And then we have non-interest income. And this is made up of all these things up here, but mainly on your particular one, it's servicing fees. So these are fees, overdraft fees, checking account, ATM fees, or things like that they're getting their income on. You can see that you get about 2.7 million on service charges and other income. So we don't get a whole lot, but we do get some, and that goes into net interest income. This fiduciary activities, that's some trust activities, so any type of investing activities, deposit service charges, trading income, investment banking insurance, and sales of loans. So, but mostly non-interest income is fees. And then we last have to pay for other people, everybody that we hire. So this is what non-interest expense is mainly based of, is we have to somehow pay for personnel, we have to operate the place, and we have to pay for rent or the real estate that we have. So that goes on here. But really what goes into non-interest expense is personnel. And personnel is usually going to be more than the non-interest income. You can see in this case, it is operating expenses of 6.3 million is what we call the non-interest expense. So that 6.3 million minus the net non-interest income of 2.7 million. So would that be 3.6 million? The difference between those two, we like to call our burden. So you got the non-interest income, non-interest expense. Difference between those two is what we call our burden, because usually that number is negative. Because usually a non-interest expense, usually, I think it's all the time, it's going to be greater than a non-interest income. And so that's a negative number, and that's what we call our burden. Because this is what it takes to run your bank, and hopefully net interest income is what you make from being a bank. And then, so we add those up. We got provision for loan losses. So, we have a total amount. So we have the provision that was total amount is 6.3 million on the previous page was our loan loss reserve. It's 6.3 million. But then each time we make a loan loss provision, so we made 1.1 million this time. So we add to that each time, assuming that if your loans get bigger, you got to make more provision for loan losses. So you got your provision for loan losses, security gains. So this is if you sell securities in the meantime. Again, we don't usually suggest that you hold securities till maturity, but if you do sell securities in the meantime, this is your profit or loss from that. You have earnings before taxes. You put your taxes in there. So that bottom part is somewhat similar to a regular income statement. This top part is different, because if you look at a regular income statement, revenues and expenses equals earnings before interest and taxes, EBIT. Our revenues are right there, and our expenses are right there. So we have different places for revenues, different places for expenses, because we calculate our interest bearing revenue and our non-interest bearing revenue. All right. We get the total revenues, total expenses. I've talked about that. Usually, we have net interest income. Subtract out the burden, profit, loss, provision for loan losses, security gains, and taxes is the typical equation of income statement. And this is what it can look like for you, and this is what it looks like. Nothing on there, I don't think. All right. This income taxes and net income, so you see we made $3 million at the beginning of the year. Now we made $478,000. So again, this is probably also a major problem that this bank is having. Now, with this $3 million, it's a little bit misleading. Because gains are sales on asset sales, gains or loss on asset sales. They sold $2 million worth of loans at the beginning of the year. So that's a little bit misleading. $3 million gain at the beginning of the year. It should really be like $1 million gain, I think, at the beginning of the year. Once you take that out. But it's still going from $1 million is what we were making all the way second quarter, third quarter, fourth quarter is down to 478. So that was the problem with this bank, is they all of a sudden fell in half of what they were making. They were making about $1 million a quarter, and they fell in half. So again, the problem that we fired that previous management from and hired y'all. So that's what we got. That's what balance sheets, income statements are like. Next time, we'll go through what's on the bottom of the sheet, the ratios that are occurring. And so we'll go talk about all these. One pet peeve of mine, I'll just tell you right now, is you start putting your stuff up before I'm done talking. Future, I'll just stop talking at that point, for good or worse, and have you go. And because if I am done talking, or if you are putting your stuff up, why should I talk anymore? And I'll just put my stuff stuff up, and we'll stop right there. And so if you want to go, after 20 minutes, you can start putting your stuff up, and you can go up 20 minutes. But you still be responsible for the material, of course. So. But anyway, I'm not mad, just letting you know. So have a good day.